Go ahead. Make my day.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Wyla, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, folks. It's Labor Day. I hope you are all taking advantage of a day off if you didn't get one. If not, I hope you're getting double time. And if you're self-employed, I hope you are basking in the glow of everything that Labor Day has to offer. I have finally wrapped up the moving of two-thirds of my children. I actually wrapped up most of that last week. That's, I realize this is a real estate show. I'll figure out some way to tie this in with real estate. Oh, I know. Life changes, right? And when life changes, you change your needs in real estate. That's how I'll tie it together. I tell you, it's amazing how, for those of you out there that are parents, or for those of you who aren't, for those of you who are children of parents, right? Because you've got to be one or the other, right? That's a big thing, man. I'll tell you, it really. And I'm probably way overthinking this. I have a tendency to do that. I have admitted that many times in the past. I think that's one reason why I'm such a data guy, is it gives me an opportunity to obsess over something specific instead of just doing things. Doesn't always work out for me. Doesn't always work great. That's another whole show. But anyway, more back to the point. It's amazing how your perspective kind of pushes forward, because it's one of those things where that classic line of best of times, worst of times kind of comes to mind. Your goal as a parent is not to raise idiots, right? Not to raise boneheads. There's a certain level of, you want them to be independent thinkers and stand on their own. And you sort of, at least everyone does it different. I mean, in my life, as my kids got older, it was incrementally increasing levels of responsibility, right? Starting with the very first cell phone they'd get, marching up to they own these duties around the house that get more complicated, more involved. And you're trying to make them self-sufficient, right? You want folks who are self-starters, who own their problems and own the solutions to those problems. And you're trying to create people who don't need you, right? Your goal as a parent is to make yourself obsolete. If you do your job right, they may walk away waving and smiling, but they're walking away. And you've spent however many years, 17, 18 years, priming these folks to jump out into life. And then when it's finally done and mission is accomplished, there's some adjustment there. And maybe not for some of you. I have, and you know what? I have people that I know who, as soon as their kids were out the door, the champagne bottles were popping, trips to, Cancun were happening. There was immediately rooms were emptied and turned into sewing rooms or offices or oversized closets. As soon as the kids were out, it was woohoo, right? Not me so much. In the wake of my children leaving, I have been making their rooms suitable for viewing. As a lot of you know, I'm in the marketing my home mode. I still find myself occasionally stepping back from that idea with the theory of renting it instead, because I've been absolutely keeping an eye on how the rental market is right now, and the positive cash flow would be pretty sexy. But again, we've talked about the utility of your money, right? How much equity do you have in a house, and would that equity be better applied to something else? In fact, and I've told you guys this before, if I was standing outside of this, if I was the real estate professional advising me, I would be poking me with a stick saying, why are you holding it? Why are you delaying? Why are you reanalyzing what you've already done? Your smartest move right now is to do what you have been planning to do. So I don't know. And there's a part of me that kind of loves this house. And the worst thing is now that the kids are gone, when I move, all their junk will go into storage, right? So what I have now is one of the big things I had to do when my kids left was clean up after them. A dumb thing I should have pushed harder before they left for them to clean their rooms. But of course, that lent itself to me going through all their stuff. They left behind all the cute little drawings they did in 5th grade. They had the photos of them and their buddies after they were in the play, so all of this kind of like, the memories, a little Barbra Streisand playing in the background. So there's that, right? There's the emotional attachment to the house. And I'm the last, or historic, if people who know me would never guess, yeah, hey, Robert is not the emotionally attached to a piece of property guy. But here I am. So I feel you. For those of you who have been clients of mine in the past, and I've been the guy to try to be the voice of reason to help you reach your goal, I get it. I completely understand all the emotion that comes into the process. So anyway, that's kind of where I am. Call it on the fence, call it questioning the direction, call it whatever you want. But now that the kids are gone, it doesn't make the decision easier. It actually makes it harder. So anyway, so there's that. I thought I'd give you that update. And and the other thing I need to do is drop I've had a few people ask me what was the ultimate outcome of my kitchen remodel. That's been done now for months and months and months. And I meant to do like a little photo shoot thing of it. And I just never did. So I will take a few photos and I'll post them, and those will go up to Instagram and Pinterest, all that stuff. And maybe I'll see if I can't dig up some of the before pictures from before, because it was not awesome before. So I think it's a great transformation. Good lessons learned from that. I shared some lessons, I think almost 6-7 months ago. I may share more, because if I had to do it again today, if it was a year and a half ago, I would do it different, and I would probably save myself about $12,000 in the way I would do it if I did it today. So anyway, there's that. Good lesson for if I ever do a flip. Okay, so there's that out of the way. I wanted to talk a little bit about what's going on with financing, and really a huge chunk of what I want to share with you is anecdotal, meaning I'm seeing it. And I got 2 emails over the last couple of weeks that really kind of blow me away, because they are from super mainstream lenders, and they are absolutely falling into that mix of subprime lending, right? Putting very, very little money down, or even getting cash out. That's really on par with what we were doing before. It's some elements of it make me feel a little bit better, but not much, right? Particularly in the context of what we already know about what's going on, how credit ratings today are not what credit ratings were 10 years ago, right? Credit ratings 10 years ago actually meant something. Credit ratings today do not. Now, 10 years ago, we simply ignored credit ratings, right? We created all these mechanisms where your credit rating wasn't even really looked at. This time, we are saying, oh, no, we really pay attention to credit ratings now, but we're artificially inflating credit ratings. So folks who today have a 690 credit rating or a 700 credit rating, 10 years ago, under the exact same financial circumstances for them personally, that credit rating would be more like 640, right? 630. But we've screwed with things to try to make it easier for those folks to get money, based on the idea that if you can borrow more money, that's a good thing. And I think we've already established it's not a good thing. You're not doing anyone any favors by allowing them to over encumber themselves. But anyway, let me jump in. So the first one is from Quicken Loans. And this is not bull. This is an email I got directly from Quicken Loans. Now, those of you who've been listening for a while know that I've pinged Quicken Loans now and again to try to get an idea if they are a really good option in terms of getting a loan. I have not used them personally for a loan, but I have gotten super great feedback, despite what I've heard, from not folks I know sources. Like there's every once in a while you'll hear something on the internet, or you'll rating thing on Google. Someone may bash the folks over at Quicken. But I've had clients who've used it. I have met people who have used it, and I've never heard anything but raving reviews. Now, of course, no one ever wants to admit they made a really stupid call on who they picked for their lender. So oftentimes, even if it wasn't a great experience, people will tend to say that it was fine. But what really reveals itself is if you are the real estate agent in a transaction, you get a feel for how good a lender is. And I have, as I said, been involved with several buyers who used Quicken Loans, and I have to tell you, they were the most responsive. They were the most follow-up I've ever seen with buyers in terms of calling and verifying that X, Y, and Z has happened, after they send information, after they do their bit. Their follow-up was great. So for me, I put them in the top tier of lenders that I've worked with in terms of just follow-through. Maybe that's not 100% across all of their representatives in their organization, but the 5 or 6 times I've worked with folks who've used Quicken Loans over the last few years have been fantastic. So there's that. But I got this email so I'm in their database. I have gone through the application process with them for an investment loan and for a regular refinance and for a few other things because I wanted to get a feeling for how that process worked. And again, totally a fantastic, great follow through. All right. But they sent me a email relating to getting special pricing on a new or refinance FHA loan. And what's interesting is they're totally pitching the whole, you only need to put, your payment can be as low as 3.5%. New rules allow you to qualify with a lower credit score. So now remember, this is an email I got within the last, let me look at the date, the last week. And they're indicating that that the credit score has been lowered. Now, I actually think I have an article that I pulled down where this was released as a news item where FHA has loosened the standards for lending. So let's orient ourselves into the lending mind space here for a second. We already know that credit ratings are artificially boosted. Folks have higher credit ratings now than they should if we are applying safe and sound standards to credit ratings, which we are not. And the folks at FHA have loosened the standards so that even lower. So the equivalent today of lending to a lower credit scored person is very aggressively into the financially challenged space since we're already artificially boosting credit ratings, right? Next on their bullet point list of reasons why you should get a loan through them is ability to roll your closing costs into the loan. So what they're saying is no out-of-pocket costs for you, except for your 3.5% down, right? No closing costs. So that's all super interesting. And we've also talked about loans over the last 6 months where even that 3.5% through some lenders can be not paid, right? The lender will pay that 3.5%. And they'll roll it into either a second or they'll do some other financial magic with that. So remember, we've talked about the zero down loans that have been happening now for about a year. But in the same week, I got another email solicitation from a lender. This one pointed at me because I'm a business owner, that type of thing, self-employed lender. But this was one that's also simply aiming at folks who would do stated income. As a real estate professional, it's safe to assume you come across clients who are self-employed and need a stated income mortgage. Now, granted, it's not some of the great loans that we were seeing being offered for folks on stated income before. Rates in the high 4s. And again, this is one that came like less than 4 days ago. But it would be a 7/1 adjustable rate mortgage. Saying you got to be self-employed. They just need a CPA letter. You have to have cash that includes 6 months of principal, interest, taxes, and insurance in reserves. So that's good. I mean, it's good that they want that kind of money. Loan to value is 70 to 80%. So that's reasonable. But they're talking about being willing to lend up to $2.5 million on stated income. That's $2.5 million on stated income. And if you include bank statements, so clearly, if you just go with the stated income, you do not need to provide bank statements. But if you want to provide bank statements, you can borrow $7 million. Check out what the minimum FICO score is. 660. That's their minimum FICO score. And remember, credit scores were already artificially bloated compared to how they were calculated 10 years ago. And according to this, cash out is okay. In other words, walking away from this with cash is okay. Interesting, right? So there's those two things. Those were direct emails to me, which I found interesting. And I think set a very interesting stage in terms of what we understand about what's been going on with lending. And it's not a good one. All right, we'll be right back with more information on this. So don't go away. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner-broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We're kind of talking about the subprime lending, the bad lending. It's got a new name, by the way. It's non-prime. Now let's define our terms. Subprime did not refer to the loan. It kind of did. I mean, it referred to the borrower. In other words, someone who is below prime lending, below the level of considering being a prime borrower, is subprime, right? So inherently, the loan is a subprime loan because it's a loan to a person who is sub-qualified, not really qualified to borrow, right? Now, instead of calling them subprime loans, they're calling them non-prime loans. And here is a scary one. This blows me away. It blows me away that these do not cause alarm bells to ring in everybody's head. This is from Reality Check on CNBC. You can find it at cnbc.com. The title of the article is Subprime Mortgages Make a Comeback with a New Name and Soaring Demand. The bullet points here are the subprime mortgage industry vanished after the Great Recession. No, it didn't. It never vanished. That's what the bailouts were for, sweetheart. If only they had. In a proper financial economy, all of these stupid lending policies, and we have to give credit where credit is due. This is as much a part of government regulation into lending as it is the lenders, because there were some smart lenders out there who said, screw you, we are not going to follow your regulations in terms of doing these stupid loans that are politically motivated and not financially motivated. Because remember, and you might be saying, well, wait a minute, they have to follow regulations. Well, yes and no. They still have to conform to the Community Reinvestment Act, and they can still be punished if they're not seen as doing lending in certain communities where folks aren't represented enough, those types of things. However, a whole bunch of the stupidity came from wanting to sell your loan on the secondary market. So if you were a bank that had no intention of selling your loans in the secondary market, in other words, selling them to Fannie and Freddie and all those folks, if you weren't going to sell those on the secondary market and go into my site, do a search, you can find long discussions about what that is. If you were a bank that didn't do that, you actually tended to come out okay. If you actually used proper lending standards to loan your money and you held on to the paper and you serviced the loan yourself, you wrote the loan and you serviced it rather than writing the loan and then selling it on the secondary market so that it could be put into the securitized market. Remember we talked about that as well, where they securitize these things, which they're doing again, by the way. Those folks did fine, which is excellent proof that when you ignore what the government tells you to do and just do things in a responsible way, you tend to come out all right, even when things take a dump. Anyway, so no, subprime mortgage lending did not go away because all the banks that did do that crap rightfully kind of went back to the government and said, hey, we were just doing what you told us to do. And they all got bailouts, right? To the tune of trillions of dollars. Remember all that? stuff that was going on where we were bailing all of these folks out. So it never went away. The institutions that did it never went away, and to a very small degree, it was still happening even early on, in different names. But it's just grown ever since about 2010. It's just grown and grown and grown in terms of stupid lending, and this is just the latest edition of it. Carrington Mortgage is now offering mortgages to borrowers with less than perfect credit. Now, let's remember, these folks are defining their terms in the exact same way that the credit rating people are, right? So they're taking at face value that credit ratings still equal what a credit rating was in 2007 and 2008, and that's just not true. So when they talk about less than perfect credit, they don't get that people have been getting loans on less than perfect credit ever since we started jerking around with credit scores about 1.5 to 2 years ago, right? The next bit is demand from both borrowers and investors is exceeding expectations, and how this people don't get that this will exceed expectations blows me away. So here we've got this fervor at a point where it's hard to find anybody. Now, remember, this is all recent stuff. These are all articles from, when is this article? This one, April. This one's from April. This is all happening now. This is all this year's stuff. And remember, we are talking about the vast majority of pundits who watch the market talking about a downturn in real estate somewhere between the middle of 2019 in through 2020. So, and I remember the other thing we've talked about is priming the subprime pump. So here we have another example of where it's happening. Non-prime lenders are now what's priming the pump. And as soon as we get a critical level of these borrowers, where will we be when the market takes a dump? We'll be worse than we were before. Now, this article goes on to state, quote, they were blamed for the biggest financial disaster in a century, subprime mortgages, home loans to borrowers with sketchy credit who put little to no skin in the game. Following the epic housing crash, they disappeared due to strong new regulation. Kinda. And zero demand from investors who were badly burned. Barely a decade later, they're coming back with a new name, non-prime, and so far, some new standards. California-based Carrington Mortgage Services, a mid-sized lender, just announced an expansion into the space, offering loans to borrowers with less than perfect credit. Carrington will originate and service the loans, but it will also securitize them for sale to investors. So, what does that mean? That means they are not going to sell it to Fannie and Freddie, right? They're going to sell it, but they're going to try to put it into securitized. They're going to skip it, right? They're going to skip remember, Fannie, Freddie, FHA, all those guys, they invented securitized loans of this type, or securitized instruments of this type that are a bundle of loans put together. These guys are just going to cut out the middleman and try to do it themselves. I hope that equals no bailout for them, but we'll see what happens. Quote, we believe there is actually a market today in the secondary market for people who want to buy non-prime loans that have been properly underwritten. So I totally support this kind of stuff. If these guys are using stringent lending standards, I'm all for it. But it sounds like by definition, they are not. They are specifically going for non-prime lenders. We're not going to back to the bad old days of ninja lending when people with no jobs, no income, and no assets were getting loans. So we'll see. We'll see how this goes. They're going to manually underwrite each loan, assessing the individual risk, but it will allow its borrowers to have FICO credit scores as low as 500. The current average for agency-backed mortgages is in the mid-700s. Borrowers can take out loans of up to $1.5 million on single-family homes, townhomes, and condominiums. They can also do cash-out refinances where borrowers tap extra equity in their homes up to $500,000. Recent credit events like a foreclosure, bankruptcy, or a history of late payments are acceptable. Recent credit events like a foreclosure, bankruptcy, or a history of late payments are acceptable. Well, tell me, what are the things that you consider measurements of a reasonably safe borrower? Well, wouldn't it be, okay, forgive a foreclosure, okay, forgive a bankruptcy, but wouldn't you at least expect a history of no late payments since those bad things? All loans will not be the same for all borrowers. If a borrower is higher risk, a higher down payment will be required and the interest rate will likely be higher. All things that will do nothing to mitigate a downturn in which a borrower finds that their home is suddenly worth less than what they owe. And we remember what happened the last time that occurred. When that occurs, we see exactly how people react. They stop making their payment when the prices drop to a certain level, or they continue to make their payments. They stay current, and then they buy that house across the street, and then they stop making payments on the first house. We'd have to see how that goes, but it's a creepy proposition. All right, so that's the private sector, right? That's not us on the hook to some degree, right? Maybe that doesn't really frustrate me. If a private company makes these kinds of decisions and then that private company takes a beating for it, fantastic. As long as your money and my money don't go to fix that, I'm A-okay with it. In fact, 9 times out of 10, that ends up being good fertilizer for the financial world, right? It's just like any other life cycle. Some businesses need to die in order for others to flourish. So in that situation, these people's mortgages don't go away, right? It's not like money just disappears. They would go into bankruptcy. Other institutions or new institutions that want to move into the market space would bid in an auction setting for the paper for these mortgages, and everything would be fine. It wouldn't hurt the borrowers at all. In fact, they'd end up with a new borrower who may even be a new servicer for their loan, who might be a better person to do that, or a better organization to do that. Okay, so there's that. Now let's talk about FHA. FHA taking significant risk with subprime mortgages. This is from magnifymoney.com. And this came out April 7th of 2015. So to show, I wanted to give you some perspective on this. Has been happening now for a while. If I'm not mistaken, we may have actually discussed this article when it came out originally in 2015, but I thought it was worth bringing up today. Risky mortgages are increasingly being underwritten by thinly capitalized non-banks and guaranteed by the Federal Housing Administration. Large banks represented 65.4 of FHA-backed loans. That number is now 29.6. In their place, non-banks now represent 62.2 of the FHA lending. This article is interesting. It goes back and shows and draws a lot of the parallels between 2007 and at that time. And things have not gotten any better. FHA has not tightened things up since then. Things have actually sort of remained status quo, or the FHA has actually embraced non-prime lending even more. So the stage is set. We are now, and have been for years, repriming this low prime, non-prime, subprime, whatever term you want to use. We've been priming that pump, and here we are again, getting ready to pay for our ticket to ride the roller coaster of the real estate biz. So here's the thing. We've talked about this before. So what do you do? I think that depending on what's going on in your local marketplace, remember, there are markets that were absolutely not impacted by the last downturn. So it may not be an indicator for you that you need to liquidate. But if you're in one of the high risk markets, some of the really bloated markets, with the other things we've talked about, remember, we've already seen major metro areas already starting to see a pivot where there are now more homes. It's shifting into a buyer's marketplace, right? Where there's now more listings. Listings have gone up and sales have gone down. Now you see that happening, and that's a change in the marketplace, particularly if you're also seeing average price going down. Here, you're not seeing that. You're seeing reductions in the number of homes sold, but you're seeing increases in price, which still indicates you've got more buyers than you do sellers. But remember, we covered this in one or two shows ago. Areas where that's not the case, where huge metro areas that I think wasn't Dallas one of them. I know there were a couple in Florida. So, and I think there was one in California. Was San Diego one that was on that track or not? I can't remember, but I know there was at least one California community that fit the bill. Go back, check that show out, see if your local area resonates with that information. It may be a great indicator on what you need to do in your marketplace. But no matter what happens, it's really all about the debt profile, right? We've talked about that before. If we start to see a huge chunk of the borrowers out there owing more than the home is worth, and that could be caused, remember, last time it was caused by shortcomings within the real estate world, right? The downturn was a real estate focused problem. This time it could start in real estate, but there's so many other things that could nudge it over the edge. Now, I think that covers it for today. A couple of other quickies that I wanted to offer. We were talking about California as an interesting market. And here are a couple of things I think are interesting because I think these absolutely push the theory that we're going to see a greater decline in the number of businesses getting started in California and the number of businesses that are going and an increase in the number of businesses that look to leave. Now, one is a bill that's going through the California House that is designed to force corporations of a certain size to have a certain number of female members of the board. Absolutely idiotic. The gender of a board member should not matter. Male, female, doesn't matter. They just need to be good at their job. So there's that. There's also talk about requiring 40% of board members to be selected by labor for those companies. That one's a little more distant, a little bit more out there. I think I actually heard that one coming from the federal level. Not sure. I just remember hearing it on the radio the other day. And finally, there is Gavin Newsom, who is it looks like he's going to be the next governor of California, and he is saying that they are going to implement universal health care in California, and it will be for both legal and illegal immigrants into the state. We already covered this. Doing that would require a ridiculous increase in taxes in the state of California. Quoting the Sacramento Bee, the estimated tax increases, and we talked about this. I think we talked about this back in March or maybe even towards the end of last year. The estimated tax increases needed to pay for a new system would be unprecedented. Under one scenario, the average statewide sales tax rate would have to jump from 8.5% to nearly 37% to generate the amount of revenue needed. Under another, California would have to create a new 15% payroll tax, withholding $150 from a $1,000 a week paycheck. Quote, the tax increases we're talking about are so ridiculously high that you can't assume there wouldn't be significant behavioral responses, people earning less income or leaving the state, said Alan Arbach, a UC Berkeley economist who directs its Robert D. Birch Center for Tax Policy and Public Finance. Now, remember, when this came up last time, the reason I brought it up was because it was getting some play. I'm not hearing it getting any play at all right now, but I had folks calling me talking about listing their house because if this program went through, because Jerry Brown was talking about pushing a similar thing, or at least someone in California was talking about pushing it. I had people saying, if this passes, I'm out and I want to sell my house. And then they even managed to find an idiot who said she'd be willing to pay higher taxes in exchange for single player. Quote, I'm already paying $700 a month for a policy. I'd rather have it be to a state system because the state is not going to have a big profit motive, according to them. I've tried private insurance this long and it's not working. Single payer wouldn't be perfect, but at least it'd be controlled by a government entity with some public oversight and not a giant corporation. So the depths of the trust and faith in government administration over your health care is staggering to me, particularly when you look at how it goes in other states. Healthcare spending in California by coverage type and program is also a chart that's included with this. In 2018, total healthcare spending comes to about $400 billion. Basically, we'd be quadrupling taxes in this state. And so the reason I say this is I think these are interesting tidbits that will play into how business handles doing business in California. At a time when when California should be absolutely trying to make it as easy as possible for businesses to do business in California, they are proceeding to make it as difficult as possible. My feeling is that this will also be lopsidedly applied to certain folks, and corporations will absolutely be bearing the brunt of the burden along with individuals. It'll be through sale. It'll be through the taxes they talk about here: payroll taxes, sales taxes, all that kind of wonderful stuff. So anyway, California is building the house that no one will live in, except for all the folks. What they'll get is all the actual folks who produce stuff, the big businesses that provide jobs. These folks are going to look to move out. We've already got now 50% of the folks here saying they want out. And as we've talked about before, businesses are going to look at that as a very reasonable option to relocate to places like Boise, Idaho, or God, what did I hear the other day? I had one person telling me their company was relocating to Reno, Nevada. and apparently everybody's on board with going. So it's not a very big company. It's actually a startup that is in Mountain View, California, and they're out. They're done. They don't like the lay of the land, so they are going to. Their lease on their building is coming up in sometime early next year. So they're leaving. They're gonna bail, and they're gonna go to Reno, Nevada. They're gonna take almost everyone is going. Almost everyone has signed to go. I think the number I heard from the person who was talking about listing their house was 85% of the employees are willing to go. None of them are going to get pay cuts. In fact, not only are none of them going to get pay cuts, their company is going to pay for them to move. So they're not going to be out of pocket to move their furniture to their new places. And they are giddy about it. Nevada has no income tax, no state income tax, and real estate there is far cheaper. So there you go. One small example of what could become a much larger scale problem for California, because obviously as the folks who make money or the things that generate money and jobs go away, the burden is more dominant on the people who remain behind. And the people who tend to remain behind are the folks who take those social programs the most. So it's absolutely a recipe for disaster. And it annoys me that I am sitting on the deck of the USS California / Titanic as all this goes on. All right, folks. I wanted to throw that little tidbit in there for you at the end. That almost deserves its own show. Maybe I overpacked today. Next time, we are going to absolutely do a very interesting one. I love doing these. This is the best places to flip houses, according to Wallet Hub. So we're going to go ahead and cover that list. We'll cover the best and the worst. We might even do a tie-in to that one where we do a video and we pick one city and go deep and let you folks enjoy that one on YouTube. Let me know if you'd like to see that. Thanks again for listening, everybody. Have a fantastic Labor Day. I'll talk to y'all next time.